There's a financial system worth $1.7 trillion. Yeah, trillion with a T. And I'm willing to bet you've never heard of it. It's bigger than the entire economy of Canada. It's growing faster than traditional banking, and only billionaires and massive institutions can actually access it. This is private credit, and it's basically the biggest shadow lending market on planet Earth. Here's what's wild about this. While you're getting a measly 4% in your savings account, if you're lucky, ultra-wealthy investors are quietly pulling in 10 to 12% in this market. Same economy, completely different game. But here's the part that'll blow your mind. This entire system is totally opaque, like zero public reporting, no transparency, just $1.7 trillion moving through deals that most people will literally never see. And get this, it's projected to hit $2.8 trillion by 2028. That's basically a 60% jump in 2 years. So in the next 18 minutes, I'm going to break down exactly what private credit actually is, who's using it, and why it operates completely in the shadows. You'll see how billionaires and institutions are accessing returns that regular people straight up cannot touch. And you'll understand the hidden risk that's connecting this whole system to your retirement account, even if you had no clue it existed. But most importantly, you're going to see how elite wealth really works. Not through stocks you can buy on Robinhood, through systems literally designed to stay invisible. All right, let's break down how this shadow financial system actually operates. So first, you gotta understand why this market even exists. For decades, banks were the only game in town for lending. If a company needed cash to expand, buy equipment, or just stay alive through a rough patch, they'd go to a bank. Pretty straightforward. Banks basically controlled the entire flow of credit in the economy. But then 2008 happened, the financial crisis, and it nearly tanked the entire global financial system. Major banks straight up failed. Governments had to step in with massive bailouts. The whole thing was a disaster. So after the dust settled, regulators were like, yeah, this can't happen again, and they introduced a bunch of new rules. Banks had to hold way more capital in reserve, they had to cut back on risky lending, and they got super cautious about who they'd actually lend money to. From a safety perspective, makes total sense. You don't want another financial meltdown. But here's the problem. Businesses still needed loans, like billions and billions of dollars to grow, to operate, to survive. And suddenly, banks were just not willing to provide that money anymore. So this massive gap appeared in the financial system. Companies needed cash, banks weren't lending, something had to fill that void. And whenever there's a gap in the market like that, someone's going to move in and capitalize on it. That's just how it works. This is where private credit enters the picture. So what actually is private credit? It's honestly pretty simple. Instead of banks lending money to companies, investment firms step in and do the lending instead. These deals happen totally privately. They're not traded on public stock markets. They're negotiated directly between the company and the investment fund, behind closed doors. Which means the loans can get done faster, they can be way more flexible, and sometimes they're absolutely massive. For companies that are struggling or growing super fast, this is incredibly attractive. But here's where it gets interesting. The investors backing these loans? Huge financial firms. We're talking about Blackstone, Apollo Global Management, KKR, Ares Management. These firms manage hundreds of billions of dollars, and they saw an opportunity that was just sitting there. If banks were backing away from lending, there was serious money to be made by stepping in. So they started building these giant private credit funds. They'd raise money from pension funds, insurance companies, wealthy individuals, and big institutional investors. Then they'd turn around and use that cash to lend directly to businesses. And here's the kicker. The interest rates on these loans are way higher than what banks charge, sometimes 8, 10, even 12%, which means bigger profits for everyone involved. Over time, this market just kept growing and growing and growing until something crazy happened. Private credit became one of the fastest growing sectors in the entire financial industry. Today, the market's worth over $1.7 trillion, and that's just the beginning. Now, let me show you why this industry absolutely exploded. So, why did private credit grow so insanely fast? Three main reasons. First, speed. Traditional bank loans, they can literally take months to get approved. All the paperwork, all the compliance, all the regulatory hoops. Private lenders can sometimes close deals in weeks. For companies that need financing ASAP, that's a game changer. Second, flexibility. Banks have to follow strict rules when they lend. It's just how the system works after 2008. But private lenders, they can design totally custom deals. They can structure loans in creative ways, and they'll work with companies that banks would straight up reject.
Third, way higher returns. This is the big one. Because these loans are riskier, they pay significantly higher interest rates. In a world where bonds are paying 4 or 5%, getting 10 to 12%, that's extremely attractive to investors. So huge investors started pouring money into private credit funds. Pension funds loved it, insurance companies loved it, wealthy people ate it up. And Wall Street firms rapidly expanded their private credit operations. But here's the thing most people don't realize. If you want in on this action, you need to be what's called an accredited investor. For individuals, that means you need at least $1 million in assets or you're making $200,000 a year. But realistically, the minimum check size for most of these funds is $5 to $10 million. That immediately locks out like 99% of people. This is strictly for the ultra-wealthy and institutions. So who's actually playing in this market? Three main groups. Ultra-wealthy individuals through family offices, massive pension funds managing retirement money for millions of people, and university endowments. Let's look at Yale University's endowment. $41 billion. They put about 10% into private credit. That's over $4 billion earning 10 to 12%, while regular people are stuck with savings accounts paying basically nothing. Or CalPERS, the California Public Employees Retirement System. It's the biggest pension fund in America, $470 billion in assets, and they've been increasing their private credit allocation every single year since 2015. Why? Because the returns are legitimately way better than public markets. Here's a real example. In 2023, Apollo Global Management made a $2 billion private credit loan to a major telecommunications company. The interest rate? 11.5%. That's an absolutely insane return in today's market. The loan was structured with specific terms that gave Apollo control if the company missed payments, and the entire deal was negotiated privately. No public auction, no competition, nothing. That 11.5% return, you literally cannot access it. It's not on E-Trade, it's not on Fidelity, it doesn't exist in retail markets. This is wealth psychology in action. The ultra-wealthy don't just have more money, they have access to completely different investments. Let me show you the math real quick. If you invest $1 million at 4% for 30 years, you end up with about $3.2 million. Solid. But if you invest that same million at the 11% private credit returns for 30 years, you're sitting on $23 million. That's 7 times more. That gap compounds across generations. That's how family offices preserve generational wealth. That's how university endowments grow faster than inflation. That's how the rich stay rich. But if you think access is exclusive, wait until you hear what they're actually funding with this money. So where does $1.7 trillion in private credit actually go? The biggest chunk? Leveraged buyouts. Private equity firms borrowing insane amounts of money to buy entire companies. Here's how it works. A private equity firm spots a target company, let's say a regional grocery chain worth $1 billion. The PE firm puts up $300 million of their own cash. Then they borrow $700 million from a private credit fund to complete the deal. They buy the company, they restructure everything, they cut costs, which usually means mass layoffs, they sell off assets, and 5 years later, they flip the company for $1.5 billion. The private credit fund, they made their 11% interest every single year, super profitable, pretty low risk because the loan was secured against the company's assets. The private equity firm, they just made $500 million in profit on a $300 million investment. Absolutely wild returns. But the company? Now they're carrying $700 million in debt. Massive interest payments every quarter, way less money for employee wages, way less money for improving stores, and basically zero financial cushion if sales drop. And here's the connection most people completely miss. Your pension fund or your 401k might be invested in that private equity firm. Your retirement savings literally helped fund the buyout that loaded a bunch of debt onto a company that could eventually go bankrupt. Kind of messed up when you think about it. Private credit also funds massive real estate development, huge commercial projects that banks won't touch anymore because of all the post-2008 regulations. In 2025, Blackstone's private credit division made a $500 million loan to a Miami real estate developer for a luxury condo tower. Construction loans are considered super risky by traditional banks, but Blackstone structured it with first lien security, which basically means if the project goes sideways, they get the land and the building before anyone else. They're charging 9% interest. The developer couldn't get that kind of financing from a bank, and Blackstone's investors are pulling returns that normal real estate investment trusts just can't match. Tech companies use private credit too. Not venture capital, that's different. This is straight debt financing for mature tech companies that don't want to go public or take on equity investors. In 2024, a pretty well-known software company took a $300 million private credit loan instead of doing an IPO. Why? Because going public means total disclosure, quarterly earnings reports, SEC filings, public scrutiny, everyone knowing your business. Private credit let them stay private while still accessing massive growth capital. But here's where this gets interconnected in some potentially sketchy ways. These borrowers aren't just random companies. They're often owned by private equity firms who are funded by pension systems who are managed by asset managers who also run private credit funds. It's literally a circular system. The same firms show up on both sides of deals. Apollo lends money to a company owned by another Apollo fund. Blackstone's private credit arm funds a real estate project developed by Blackstone's real estate division. This creates what's called counterparty risk. When everything is connected like this, a failure in one area can absolutely cascade through the whole system. And unlike traditional bank loans where regulators can actually see what's happening, private credit is fragmented across hundreds of funds with zero central oversight. This brings us to the question that should honestly keep you up at night. What happens when this thing goes wrong? Here's what keeps financial regulators awake at night. Nobody actually knows the true level of risk sitting in this system. Traditional banks have to report their loan portfolios. They have to hold capital reserves. They get stress tested by the Federal Reserve on a regular basis. When banks start making too many sketchy loans, regulators can see it happening in real time and step in. Private credit has literally none of that oversight. There's no comprehensive database of private credit loans, no standardized reporting of defaults, no central authority tracking the total leverage in the system. That $1.7 trillion figure, that's just what the industry voluntarily reports. The real number could legitimately be higher. We just don't know. And here's the scary part. Private credit funds use leverage themselves. They borrow money to make loans. So you've got debt funding debt. It's basically turtles all the way down. A private credit fund might raise $1 billion from investors, then they borrow another $500 million from banks. Now they've got $1.5 billion to lend out. When those loans pay interest, the returns are amplified. Investors are happy, everyone's making money. But when loans start defaulting, those losses get amplified too, and things can go south really fast. This exact dynamic almost destroyed the entire global economy during the 2008 financial crisis. Banks lending to homeowners who couldn't actually pay. Nobody knew where the risk was hiding until everything collapsed at once.
We're already seeing some warning signs. Default rates in private credit started creeping up in 2025. Not crazy yet. They went from 2% to 4%, but that's literally a doubling. And remember, these are supposedly the safer, higher quality loans compared to what banks make. There's also this massive refinancing cliff that's coming. Between 2025 and 2027, hundreds of billions of private credit loans need to be either refinanced or fully repaid.
Companies that borrowed at 8% back in 2020 are now looking at 11 or 12% when they try to refinance because interest rates went way up. Some of these companies straight up won't be able to afford the new rates. They'll default. When they default, the private credit funds eat those losses. And when the funds take losses, the pension funds and endowments invested in them take losses too. Your retirement account might be earning a solid 10% in a good year, but if the underlying loans start defaulting at 5 or 6%, suddenly you're taking hits in an asset class you thought was basically safe. Mohammed El-Erian, the economist who literally predicted the 2008 crisis, said in a Bloomberg interview last year, "Private credit is systemically important but systemically opaque. We won't know if there's a problem until we're already in the middle of one." Now, look, this doesn't mean the whole system is definitely going to crash. A lot of these loans are actually well structured. Many borrowers will be totally fine. But the lack of transparency means we legitimately cannot assess the true risk. Nobody can. It's like flying a plane with zero instruments. Everything might be perfectly fine, but you won't know until you're about to hit the ground. And here's the final kicker that nobody wants to talk about. When, and I'm saying when, not if, some of these funds start taking serious losses, who bails them out? In 2008, the government bailed out the banks because they were too big to fail. But private credit funds aren't banks. They're not subject to the same rules or protections. Legally, the government has zero obligation to rescue them. But if CalPERS loses billions in private credit and suddenly can't pay pensions, if Yale's endowment gets crushed and they have to slash financial aid, if family offices managing billionaire wealth see their safe private credit investments totally implode, the political pressure to step in and do something would be absolutely massive. So if this system has all these risks, why does it even exist? The answer shows you exactly how modern wealth actually operates. Private credit exists because of something called regulatory arbitrage. Basically, after 2008, the government made traditional banking way safer by adding a ton of restrictions. Banks had to hold more capital. They couldn't make as many risky loans. They had to be way more transparent about everything. Those were honestly good rules for preventing another financial crisis, but they had this unintended consequence. All that lending demand didn't just disappear. It moved outside the regulated banking system instead. Private credit is literally what happened when lending went underground. And the people running these funds, they absolutely love it this way, because opacity is actually a feature, not a bug. When you're a private credit fund, you can negotiate deals that would never fly in public markets. You can charge way higher fees. You can structure loans with terms that would make headlines if they were public. And you can operate without anyone really scrutinizing what you're doing. The fund managers are making absolutely insane amounts of money. Private credit funds typically charge a 2% management fee plus 20% of all profits. On a $10 billion fund, that's $200 million in management fees alone, every single year, whether the fund actually performs well or not, plus another billion or two in performance fees when the loans pay off. For the ultra-wealthy investors, it's worth it. They're getting returns they literally cannot find anywhere else, and they're sophisticated enough to understand and accept the risks. But for pension funds, for endowments managing money that's supposed to fund retirements and college scholarships for decades, the risk-reward equation gets a lot murkier. They're chasing higher returns because they made promises they can't keep at 4% yields, so they move into riskier stuff like private credit, which works great until it doesn't. This is how wealth operates at the top,
through systems built on leverage, opacity, and access restrictions. The rules are different because the rules were literally designed by the people who benefit most from them. Before we wrap this up, there's one final thing you need to understand about what all this actually means. Here's the part that nobody really wants to talk about. The real story here isn't just the financial risk, it's the massive divide this entire system creates. While institutions and billionaires are quietly earning 10 to 12% in private credit, regular investors are completely stuck with 4% in bonds and savings accounts. Over 30 years, that gap compounds into absolutely insane generational wealth differences. Your parents' pension fund might be deep in private credit, but you personally, you can't touch it. Yale's endowment uses it to fund scholarships, but the students receiving those scholarships can't invest in it themselves. Family offices use it to preserve dynasty-level wealth across multiple generations, but unless you were literally born into that wealth, you're locked out completely. And this divide is just getting wider. Private credit is projected to hit $2.8 trillion by 2028. More money, more exclusivity, more concentration of returns among people who already have access. Understanding this system doesn't mean you can actually access it. That $5 to $10 million minimum makes absolutely sure of that. But it does show you how elite wealth preservation actually works in the real world. Not through the stock market, where everyone theoretically has equal access, through shadow systems, where access itself is the barrier. That $1.7 trillion, it's the invisible financial architecture that separates institutional wealth from individual wealth, and it's growing every single year. This is how wealth operates at the top, hidden, exclusive, and designed to stay that way. If you want to understand more about how these elite financial systems actually operate, hit subscribe, because this is just the beginning.